hit the record button and let me share my screen with you. Okay. Whilst we get to it, I'd like you guys to open your textbooks to question 5.1. I'd like us to do question 5.1. So if you guys could flip there. Again, if we could just flip to 5.1. I want us to do 5.1 and 5.3 today for class. I'm just quickly looking for, yes, this is what I'm looking for. We're going to need this for a portion of the question that we go through later. This is probably still unit 4. Yep. Okay. Okay, this should be unit 5 now. There we go. All right, cool. Right, we'll come back to this. I said unit 5, yes. And we're doing 5.1. All right, cool. Right, ladies and gentlemen. There we go. Okay, awesome. So, what's going on? Remember we said we are doing partnerships in Learning Unit 5, okay? We're doing partnerships there in Learning Unit 5. So what's happening here is we're now obviously getting into this, only looking at the equity accounts because those are the only accounts that are different, okay? So what we then want to do is then deal with what are the differences, basically. Okay, that's what we want to then do. So let's look at what's going on in that question. Okay, we go to the required. It says, show how the adjustments as per the partnership agreement will be reflected in the general ledger of Downtown Partnership. All right, that bit we are going to look at in the answers. Okay, what I want us to do is to generalize the adjustments. Okay, and then the last bit there, it says draft the statement of financial position of Downtown Partnerships as at February 28, 2007, as well as the statement of changes in equity for the year ended 28 February 2007. Only the note for long-term borrowings is required. Okay, cool. So let's get into it. So flip the page back, okay? The following information was obtained from the records of Downtown Partnership, a partnership with two partners, okay, Mrs. Down and Mr. Town, okay. The financial year of the partnership ends 28 February annually, okay. Abbreviated trial balance of Downtown Partnership on 28 February 2007. Okay, we're doing this for 2007. Okay, so that's fine. Okay, there you've got the capital balances for each partner. You've got the current account balances for each partner. You've got the drawings balances for each partner. Can you see drawings is not one account, it's two separate accounts. Okay, and then you have property, plant, and equipment. And then you have mortgage loan, all right, 14.5% per annum. And then you have the profit for the year, okay? All right, then it goes on to tell us the partnership agreement stipulates the following. Interest on capital account must be recorded at 7.5% per annum. Capital balances remain constant, okay? So what are they informing us here, right? Remember I told you that we use the current accounts to reward or penalize partners within the business. Let me just check if there are any comments or thoughts from here. Okay, we're all good so far. All right, cool. Right, so we then ask ourselves, okay, how then are we going to record this? If you look at the capital account, remember it said interest on capital accounts, okay? So the account that's going to be affected is interest on capital, okay? But now we look and we say, okay, what are the capital balances for our respective partners, for our respective partners? Mrs. Down, 212,000, okay, and Mr. Town, 176,000, both of which are credit balances. So we're happy about this, all right? We're happy about the credit balances. So that means that we are actually going to reward them because they have credit balances. I'm trying to just, okay, let's do this. Why is it not responding? Sometimes though. Okay, let's refresh. Okay, and you can see there I've left the narration in there. This narration, interest on capital appropriated at 7.5%. Okay, let's close that up there. There we go. There we go. Okay. So since both of them have credit balances, let's start though with the, so we're going to credit their current accounts. Remember, current account is also a equity account. So it increases on the credit side and decreases on the debit side. Okay, Mrs. Down. I'm just going to copy that and paste here. And then just quickly amend to say Mr. Town. Okay, so obviously the account, that's the other account that's affected, is interest on capital. Okay, there we go. Right, so we then now need to do the calculations because we're saying 7.5% of Mrs. Down's, so that's 0.075 times 212,123. Okay, and now I'm sure we're starting to get very comfortable with the, okay, this was for the whole year. Remember in the additional information, what did they say? They said capital balances remain constant. Okay, so that was the same for the whole year. 7.6. Okay, and if you work that out, here you'll find you're going to have an amount of 15,900, and here you're going to have an amount of 13,200. Okay, so obviously interest on capital is going to be the addition of both of those. And can somebody in the chat give me the answer there? 15,900 plus 13,200. Okay, what does that give you? Somebody tell me in the chat. 13,900 plus 15,000. Oh, sorry. If 13,200 plus 15,900, 29,000. Okay, so you have 209. Yes. So I think you just threw in an extra zero though, but thank you, Callum. Thank you, Shakira. Yes, that is 29,100. Okay, let's just do this. Okay, so 29,100. Okay, out with the first year-end adjustment that needs to be made. Then the next one is interest on drawings must be charged at 10%. Can you see we're charging here? Okay, and this interest on capital, let me actually zoom in a bit. This interest on capital is an expense to us because we're paying this out to the partners. Okay, we're paying it because we're rewarding them. Okay, right. So this next one here we have interest on drawings. Interest on drawings is charged at 10% per annum, as if the drawings were taken 3 months prior to the financial year end. Okay, so these partners are smart. Okay, they're only taking it 3 months towards the end of the financial year. Okay, so obviously we're going to penalize them for this. So again, it's happening through the current account, and I might as well just copy this whole thing here so that we can just make adjustments. Okay, let me do the same over here. The beauty of technology, huh? Okay, so how much, what percent? They said 10%. Okay, no problem. Okay, and her drawings was 24,000. Okay, 10%, and his drawings were how much? His drawings was 18,000. Okay, so somebody tell me there in the chat, what do these, what amounts do we get there respectively? And this is interest on drawings. On drawings. Okay. Right. So I heard the chat going off there. So we have 2,400. So what does the letters in the folio column mean? Okay, good question. We'll have a look at that now. 1,800. 1,800 for, oh, my bad. You're right, Kellum, but I forgot to add in something. Remember, they said 3 months. They said what? If the drawings were taken 3 months prior to the financial year. So this is not for the whole year. So here we need to apportion it again and say 3 divided by 12. We do that for both of them. Okay. So this, whilst you guys recalculate there for me, what we have here in the folio, you can see the N there is for, it basically means this is an account that falls into the nominal section in the trial balance. The B stands for balance sheet section in the trial balance. That's all that they really mean. All right, I hope that answers your question. Okay, so 600 and, okay, right. So 600, yes. Okay. All right, awesome. All right. And then for Mr. Town, I calculated 450. Okay. And can you see interest on drawings? What are we doing with it? We're crediting it. All right, so that is an income to us, all right, because we're penalizing them and obviously receiving the money. So 400 plus 450. Okay. Huh? Okay, no problem, no problem. All right, awesome, guys. Awesome stuff. So we've dealt with the first two. We then move on to the next one. Interest on current account must be recorded at 4% of the opening balance. Okay, so here we are now rewarding them for having a positive balance on their current accounts. Remember, the current account is like the capital account. Only difference is the capital account we use to record all capital contributions and only capital contributions, and the current account we use for everything else, okay, to reward and to penalize the what you call it, um, the partners in the business. Okay, so here we look at the respective partners' balances. Okay, looking at the current account, we see Mrs. Down has got a debit balance on her current account, her opening current account balance. So since it's a debit, that means we're actually going to penalize her. Okay, we are actually going to penalize her because we know that it's the current account is an equity account, right? And equity accounts increase on the credit side and decrease on the debit side. Okay, so there we go. Then what was the interest rate? 4%. Okay, there was no apportionment there. And the amount, the balance was 40 something thousand, 43,400. Okay. Was there any apportionment? Nope. I don't see anything there. You guys can get me the answer to that, please, whilst I put together Mr. Town's situation. His balance was a credit balance. Okay, so his account we are then obviously crediting. Okay, because we want to reward him, because we know a credit balance means that there's money in the account. It was not in the negative. Okay, and his balance was 36,300. Or is it 36,500? 500. Okay, right. So what amounts do we have there? What amounts do we have there? Okay, Mr. Downs. Sorry, Mrs. Downs. Okay. I think you're just giving me an extra zero there by my calculations. That's fine. Okay, so we said we're debiting because she obviously has a. Okay, and then for Mr., we're obviously crediting because we want to reward him. Okay, and then now remember this is interest on current account, so we don't know, are we supposed to debit or are we supposed to credit? Okay, now the only way that we'll know is by getting the difference. So remember, us debiting Mrs. Down, that's income for us, all right, because we're penalizing her, we're reducing her balance, and us crediting Mr. Towns, that's money leaving us. Okay, so then can you see the money leaving us? Sorry, the money coming in is greater than the money leaving us. Okay, so that means we're going to credit interest on current account. But again, you'll see what I was just saying now. I'll re-explain it. Here we're saying the money we're receiving is 1,736. That's the amount that we're penalizing Mrs. Town by. Okay. And the money that's leaving us is this 1,460 that we are rewarding Mr. Town with. Okay, so the difference between the two is, please just let me know there in the chat. Okay, I heard somebody, 276. Thank you very much, Kellam. That is correct, 276. Okay, right. So that's all that we need to do there. Okay, right. That's all that we need to do there. Then we go on. And that fourth adjustment they're saying there, the partners must receive the following annual salaries. These are not regarded as operating expenditure. Okay? So these are salaries but not operating expenditure. Remember I told you that the partners get special salaries, maybe if they've met targets. All right? So this, we're considering it as a reward, okay, for them being partners, for them having ownership in the business, okay? So they've told us the respective amounts there, okay? So here we just come and we say, okay, that's an expense to us, so salary, okay? That's down, okay? And here we also have then her current account. Okay, completing that double entry. Okay, remember we said we're rewarding them. So I'll copy that. And we're going to credit Mr. Town's account as well, and then here. Okay, and there we go. So how much was the salary for Mrs. Down? That was 10,000. For debit and credit, 10,000. And for Mr. Town, it was 25,000. 25,000. Okay. Hit something in the chat. Okay. Cool. So we've dealt with that as well. Can now come down to the next adjustment. Okay, and here it says Mrs. Down must receive a bonus of 10% of the profit for the year. A bonus. Okay, so here we have a bonus. Okay, much like salaries, this is an expense to us because we're rewarding one of the partners. 10%, so let's calculate there, 10% of the profit, which is 350. Okay. So 35. 021. Am I correct? Thank you very much, Kellam. Thank you very much. All right, cool. Then we also have obviously we need to reward her via her current account. And it's for the exact same amount, 35. Okay, all right, there you can see the narration. Bonus to partner at 10% of net profit. Okay, then what's the last thing that they have for us there? They say the remaining profit or losses must be distributed between partners down in town in the ratio of 3:2. Round off to the nearest rand. Okay. So basically, Mrs. Down owns 60% of the business and Mr. Town owns 40% of the business. Okay, right. So here now, we use the appropriation account. Remember what we use the appropriation account for? To distribute profits between partners. Okay, so we come here. Appropriation account is a final account. Remember the rewards. So here, since we made a profit, the reward that these guys are going to receive, again, is going to get paid out to their respective current accounts. But we need to calculate the exact profit that's going to be paid out. Because remember, we've had all these things that we've needed to pay out and receive from the partners. So now we then say, okay, what was the profit that we had before any of these adjustments? The profit was 350 to 10, okay? But then we had interest on capital, which we paid out to the partners for 29,100, okay? And then we had interest on drawings, which they paid to us because we were penalizing them, all right, for drawing money out of the business. So here we then, that's a plus for us because that's money coming in. And that was 1,050, okay? Money we received, okay? But then we also had interest on current account, okay? And overall, they were actually paying us, not us paying them, okay? So we say then another plus 276. Okay. Then we had salaries and wages. So you add that up, 10,000 plus 25,000. All right, that's money leaving us. That's 35, negative 35,000. Okay. And then finally, we also have Mrs. Down's bonus. So another negative 35,000. There we go. Okay. So when you calculate all of that, what is the profit that's going to get paid out? And we're going to debit this because this is money leaving us again. What is the profit that's going to get paid out to the partners? Okay, 252,415. That is correct. 252,415. Okay. Now, so we know how much profit is actually going to get paid to the partners. Now the question is, how much is each of these partners actually going to receive? So we then say, okay, we know we're going to credit their respective current accounts since we're rewarding them. I heard something in the chat. There's one of you guys calculating these things. Current. Okay, so I'm just going to write out the calculation, but I'm sure you guys have already calculated it. 252,415, and then we're saying with Mrs. Down, we know her share is 3 out of 5. Okay, since we're adding both her share and Mr. Downs. That's how we're getting this 5. Mr. Downs is 2 out of 5. So I can quickly just copy and paste there and then just change the 3 to a 2. Okay, you can see that 3 plus 2 equals 5, and that's why we're saying the whole pie of what is being shared is out of 5. Okay, let me see what people are saying there in the chat. Okay, thank you very much, Callum. Yes, that looks correct. Okay. So those are all your journal entries. Can you see? That's how you record the necessary adjustments for year end under a partnership. Can you see? It's just that simple. Obviously, in a sole trader, we wouldn't have these accounts. Okay. We wouldn't have an appropriation account. We wouldn't have these things. Okay. Right. But that's not all that they wanted us to do in this question. Okay. This is now where we go to see, okay, how would these things also be recorded then in the general ledger? Because remember, they asked us to do the general ledger. Okay. And there you can see Mr. Downs' current account. Okay. All right. And there you can see there's the opening balance of his current account. And then obviously there was drawings that took place. Remember, drawings gets closed off to the respective current accounts and not the capital account. Remember, we're under a partnership, so this is just a slight change there. Then interest on drawings, can you see it's decreasing the current account? We're debiting these amounts. Okay. Oh, sorry, this is Mrs. Down. Okay. Then interest on current account. Again, she had a debit balance, so we're penalizing her again. Then we had interest on capital. We crediting that. Salaries from Mrs. Down, crediting that, rewarding her. Bonus to partner, rewarding her. And there's her profit share, rewarding her again. Then obviously we balance the account. And this time, look, she actually has a credit balance, which is good. Mr. Town, take a look at his situation there. He had a credit balance on his current account, which is good. And then he had interest on capital, interest on current account, his salary. Okay, he had drawings, which again gets closed off to the current account, not to the capital account, because we're in a partnership. And then we had interest on drawings, okay, where we penalized him, so we debited, okay, and then obviously we balanced the account after calculating the profit, okay, and there we are. And then here you can see the drawings account. Remember, under drawings, when it comes to drawings, we have individual drawings accounts for partners, okay, so there's Mrs. Down. You can see she had drawings of 24,000. And again, remember what I told you? The drawings is closed off to the current account of that partner. Can you see there? Current Mrs. Down 24,000, bringing that account to 0. Again, we see the same thing here with Mr. Town. Had a debit balance for drawings, and then it gets closed off to the current account, or his personal current account, should I say. Then interest on capital. Okay. Interest on capital gets closed off to the appropriation account. Remember, I told you guys, this is money that we've paid or that is leaving us. So you can see we're debiting, and then obviously we're crediting the appropriation account. Okay. So in other words, when we get to the appropriation account, you'll see that we've actually debited the appropriation account, since here we credited. Okay. Then we have interest on drawings. Again, here we're punishing them. So here, can you see it's income to us? That's why we're crediting here on interest on drawings. And then obviously we closing it off to the appropriation account. Okay. Interest on current account. There you can see we were penalizing Mrs. Down, but we were rewarding Mr. Town. And the difference we obviously closing off to the appropriation account. Okay, salary for Mrs. Down, 10,000, money leaving us, so that's why we debited that. Okay, gets closed off to the appropriation account. Salaries, okay, again, money leaving us, so we're debiting, and then gets closed off to the appropriation account. Bonus to partner, money leaving us, so we're debiting, and then gets closed off to the appropriation account. And here now you can see the appropriation account. Let me see, was I? Okay, yeah. So there you can see now the appropriation account right here. So sometimes they might ask you to just do the appropriation account, and we'll see this in question 5.3 that we're going to do, which will be the last thing that we do before we call it a day. Okay. Okay, and this calculation, remember we did this calculation together when we were calculating what was the net profit. Okay, so you can see all your expenses, they are getting debited, and then all our income is getting credited. Okay, right. Profit and loss, interest on drawings, interest on current, and here all our expenses. Okay, right. So we now seen what you need to do in the general ledger. But now what I want us to do is to look at the statement of changes in equity. Okay, and you can see that it's different from what we've seen before. Okay, we have the current accounts for both partners, these two here, and we have the capital accounts for both partners. Remember, we said we're only using capital to record capital contributions. All right, so here you first throw in the opening balance for the respective capital contributions. Okay, and then obviously we have the profit that we had. Then now we want to account for, there were salaries to partners. Okay, and I believe that the salaries, it was 10,000 to 10,000. Remember, this is coming out of the current account. So it was 10,000 to Mrs. Down, sorry, and 25,000 to Mr. Town. So here you just put 10,000 because that's increasing the current account. Can you see that? So it remains a positive. Here there's no debit or credit, so we do need to put brackets around it if it's a negative amount and a positive around it if it's a positive. And sorry, no brackets if it's a positive amount. Then here, obviously, this is going to reduce the appropriation account, right? So here, we actually are going to write in brackets 35,000. Okay. And this profit here is also supposed to be here. Because remember, the profit gets distributed from the appropriation account to 10. Okay. Bonuses, only Mrs. Down received a bonus, and that was for 35,021. Okay. All right, this is also another negative. Okay. Interest on capital. Again, they both had credit balances, so we're rewarding them 15,900. And here 13,200. That obviously is reducing the amount of money that we have in the appropriation account. 29. Okay. Interest on current accounts. Hey, that's money that is we're receiving, so it's a negative on the current account of Mrs. Down. Okay, she's paying us. So here, what do we say? Negative 717.36. And here for Mr. Town, we are paying him, so that's a positive in his current account. Okay, and that gives us a overall positive of 270 something, 276. Okay, right. Then we went to interest on drawings. Interest on drawings. We penalized both our partners this time. It was 600 for Mrs. Down, and it was 450 for Mr. Town, which made it 1,050 money being paid to the company. Then the last thing there is, well, second last thing, we had partner share of the total comprehensive income, or in other words, share of the profits. So for Mrs. Down, we know it was 151,449, and for Mr. Town, it was 100,966. So the total that was wiped out of the appropriation is then 252,415. Okay. Right. Then last but not least, and I'll give you guys a break now, we then have drawings. And we said drawings is taken off of the current accounts for the respective partners. So we know for Mrs. Down it was 24,000. Okay, and that should be a negative because that's going to reduce the capital. And this, or should I say your current accounts, 18,000. Okay, right. And that's pretty much how you fill out this document right here. But then obviously we need to calculate the total here, but I'll just give that to you. That's going to obviously end up as 0. So I'm just putting a dash there. So obviously, because we didn't reserve anything, we paid all of the profits out. Okay, we didn't keep any retained earnings. And can you see here, under the capital accounts, can you see the balance that you began with was the balance that you ended with? Because literally this is just for capital contributions. Okay, but there were no capital contributions during the course of the year. All right. So I'm going to park it there for now, and then we'll proceed after the break. I just want to show you guys one thing before we move on to question 5.3, which is a shorter question, a much shorter question. I don't know if there are any questions. I didn't hear the chat go off, but if there are any questions, guys, you know the drill. Drop it in the chat, and then when we come back, that'll be the first thing that I then deal with. Okay, right, awesome stuff. I'll see you guys in 10, and please feel free to drop your questions in